Good afternoon, everyone. Thank you so much for joining us today. My name is Maria Asher, and I'm a co-portfolio manager on Westwood Select Equity and Dividend Select Strategies. Today, we wanted to take this opportunity to talk about what's been going on in the markets. It's been an unprecedented year where we have seen markets getting rattled by a record high inflation data as well as Russia's invasion of Ukraine. For that, we have Leah Bennett and Adrian Helfert joining us on the call as well. Leah is the president of Westwood Wealth Management, and Adrian is our CIO and the director of multi-asset portfolios here at Westwood. Hi, Leah and Adrian. How are you doing?
Very well, thank you.
Hi, Maria.
So thank you so much for joining us, and let's get started and talk about something that I think has been the major driver of market volatility this year, which is inflation. We have seen record high inflation, 40-year high inflation, which has, and then we saw some slowdown in July, where the inflation came down at 8.5%. We get inflation data for August tomorrow. Fed Reserve so far has reiterated multiple times that they are going to continue to raise rates till we see inflation come under control. So what is your outlook for inflation going forward?
Sure, I'll start. And you hit it on the head. The Fed has been very explicit that they need to see realized inflation come down. This is a little different than in the past, where the Fed has communicated that they're going to look well forward in the future at expected inflation metrics. There's still some of that, but they want to see today's inflation come down. So prints like we have tomorrow, data like we have tomorrow, which is that measure of the average change of the prices paid by urban consumers on a market basket of consumer goods coming down, is an important metric for the Fed. We had it last time, as you said, partly related to energy prices coming down, and there's volatility in energy prices, which is why the Fed and investors like ourselves generally follow core inflation. Core inflation, ex food and energy volatility, needs to come down from around 6% to 2%, which is the Fed's barrier. That's not going to happen for some time. That said, inflation risks are still tilted somewhat to the downside, I do believe. We're seeing some of this in used car pricing that has come down in August. The used car price came down 4% on average. We are looking towards seeing some drop in house prices associated with increased rates and increased mortgage prices impacting that. That's the shelter category in core inflation, and that's 33% of the basket. So that will have a negative impact on inflation pricing coming down, or a positive impact on the markets if that happens, because the Fed will then respond accordingly. Other things that are impacting right now are, of course, COVID and the supply chain. When we see a cessation in some of the supply chain troubles, then you're going to have lower inflation. You're going to have an ease of companies getting goods. And what's happened is, because of the supply chain troubles, companies have built up a larger inventory in order to meet consumer demands. That's deflationary in and of itself, as companies then will be selling off some of that inventory in the future and not purchasing from their supply lines for some period. So that could have a negative impact. Inflation has a downside risk to it, but the big ticket item is very much, as you said, until we see it in the realized data, until we see it multiple times from last month to this month to next month, saying inflation is at a considerably lower level that is not going to negatively impact the purchasing power of the lower income consumer, then let's expect the Fed is going to keep its foot on the brake.
Yeah, I agree with a lot of Adrian's thoughts, and I even think about I do think we're going to continue to stay in a period that's very volatile for the market. So there's lots of uncertainty, and even if I think going back a year ago, the Fed's priority was really on unemployment, making sure unemployment came down. And now we've switched more to this priority about making sure that inflation comes down. So you've had a big shift with the Fed, and it will be interesting to see what the print is on Tuesday. Again, Adrian mentioned used car prices coming down. You've also seen gasoline prices come down. Rent is starting to come down. And then we obviously have some stickiness around food with the issues with Ukraine and Russia. probably some stickiness with wage inflation. So there's definitely a pull going on. And then, we're talking a lot about near term, and I think there is going to be emphasis on what happens over the next 6 months in particular. But if you look further out than that, I do think the inflation situation will be interesting because you continue, as we have more stress with labor and with the supply chain, you're continuing to get more and more investment in technology. So technology as a percentage of capital expenditure is now 52%, which is a record high. It's the highest it's ever been. And I think that will certainly have a major impact on a contra impact on inflation. And so I think that's a big positive for the future. But again, you're looking 12 to 18 months down the road for that really starting to impact inflation.
Thank you. That was super helpful. So let's shift our focus to markets. We saw markets kind of bottom in June. They staged a rally in July. August and September have so far been a mixed bag. So do you think that was a bear market rally, and do you expect market forming another bottom this year?
This is always the crystal ball question. And I think the point that we were just talking about relating to inflation is a good one about you are going to have increased volatility on the upside and downside. I think what's important when people talk about the markets is the markets are not homogenous. So you've seen even this year these massive rotations between just looking at the US between value and growth. And so I do think there are some opportunities in which to invest. I think you have to be really thoughtful about how you're putting money to work. So before even talking about asset classes, I think it is important for people to look at their financial plan or to look at their risk profile and see what level of volatility they're willing to withstand. And then I think chipping into the markets is something that does make sense. Again, if you look at, we recently reduced our exposure to emerging markets and Europe. The dollar continues to be really strong. Emerging markets have a big headwind despite being more attractive from a valuation perspective, and that's likely to continue for a while. You've got all the stress that's going on with Europe, with higher oil and gas prices, and recently it looks like the government's willing to make some sacrifices and help consumers with their bills. But again, that goes to increased government stimulus and increased government debt coming out of COVID, and that presents a risk. Within the U.S., growth is trading at a big discount to value, but it's a very volatile asset class. So it's something that does make sense from a discount perspective, but you have to be very patient if you're starting to allocate money in that area and be able to withstand the volatility. Again, as we get these inflation prints, you're going to get the markets kind of whipsawed. So I think just starting to chip in is something that makes sense, but in a way, in a disciplined manner.
I agree. There is some cautiousness that is warranted as we see higher risk premium from these things that Leah points out. If you're sitting on the sidelines, though, there are opportunities being created by the volatility that we've seen in the markets, and trying to find those and take advantage of them as we come through this cycle is certainly a smart investor thing to do. Just from maybe taking a different tact on this, let's just think about when we talk about market pricing, and for instance, we say about the bottom on the S&P 500. What is that? Of course, that is one way to think about it anyway, in a simplistic framework, is you're looking at the current earnings and price that an investor is willing to pay per unit of current earnings. Well, current earnings across all these companies right now is likely to take a little bit of a hit, as companies are for the third quarter potentially going to downgrade their earnings estimates as they're taking heat from the Fed. They're looking at what they're being told explicitly about the potential for demand, and they want to beat their earnings. And so we may actually see their estimates start to come down. The second piece of the pricing puzzle then is, how much are investors like ourselves willing to pay per unit of current earnings? And there's two pieces of that. One is, how much are those current earnings going to grow in the future in 1 year, 2 years, 5 years, 10 years? And then the second piece is, how much are those earnings going to be worth in the future after discounting by inflation of the dollar and higher interest rates and, of course, risk premia? So when we think about it, we see current earnings that potentially are going to get marked down a little bit from CFOs and CEOs that may take heed from the Fed saying demand is going to come down and being cautious in their own outlook. When we think about the growth of those earnings, it's a little harder to tell. It depends on how long this phase persists, both on the Fed, on the geopolitical risk premium, et cetera. But we do see a potential for a lower growth environment than we have seen in the past when prior to 2022, we saw 16+% average S&P 500 returns, a little lower profile. Discounting effect is also it's an unknown, but as Leah mentioned on the growth equity versus value equity paradigm, it has a high discounting effect, especially when a company earns a lot of their cash flows well into the future. As interest rates rise, if they continue to rise, that will have a negative impact on overall market valuations because it means higher discounting. Where we are right now is cautious, but there are opportunities being created by the sell-off that we have seen in the markets.
Yeah, and I do think there's still a lot of pessimism. There's obviously a lot of risks that are out there. In a lot of ways, that's a positive because there are a lot of things that have been discounted into valuations. And again, I think time frame is really important. But it's whether or not we go back and test our lows. I think that's a question I hear a lot. It's hard to know, but again, I do think there are opportunities, and you just got to look at your time frame about when you want to commit capital.
Thank you so much. I wish we all had a crystal ball and our lives would be easier. But okay, so let's shift our focus to fixed income. As I mentioned earlier, it's been an unprecedented year. We have seen multiple asset classes sold off a lot. Fixed income is even, traditionally safer or high investment grade quality bonds have sold off. So what is your outlook for fixed income asset class, and where would you position yourself within fixed income?
Sure, I'll start, and let me know when you find the crystal ball, as that would be very helpful on seeing the future. Fixed income has had an extraordinary year, and an extraordinary year to the downside. By some measures, just the return on the 10-year U.S. Treasury up until mid-year was the worst year that we'd had for a start since George Washington was president. I like the statement. I don't like the return profile, but it gives you an idea of how difficult it's been. We've seen a wholesale shift in the Fed mechanism, not only from the fact that they are hiking rates, but also from the fact that they're saying we're no longer going to provide a so-called put to the market. We're going to be less observant because inflation is coincident and high. That may also mean there are extraordinary opportunities in fixed income where fixed income yields in the risk-free space, that's government bonds, suddenly are more attractive. In the more risky space, that's corporate bonds, investment grade and high yield, are suddenly more attractive. And if we, this is back to the last question, if we suddenly look at a prospective economic growth environment that is maybe a little lower, just what we're being told and guided to, then that likely means an S&P 500 environment that is not 16%, that is potentially a little lower, the average historical around 12%. So if we're in a 10-12% environment for several years, suddenly 8.5% on a high yield bond or 5% on an investment grade bond looks pretty decent relative to your overall return versus a 16% return when high yield returns were 5%. So as investors look at this, especially income-oriented investors, we think it is appropriate to hold fixed income as a consistent piece of your portfolio. The yields are good and strong, and now granted, good selection is necessary, but relative to the overall target returns of the market, it is more attractive now. Last piece of this is on risk-free rates on government bonds. Historically, they've been a risk buffer. So when the S&P 500 drops, just as one optic, then oftentimes yields drop as well to reflect lower growth. When yields drop, prices go up. It provides an investor buffer for your portfolio. That is more attractive when yields are at 3.5% on a 10-year bond than when they are 1.5% on a 10-year bond. So something to take note of is that insurance policy, which you get paid for, is suddenly more attractive than it was before, and we think it will start working again when rates stabilize. But cognizant of the fact rates haven't quite stabilized yet. We think corporate bonds are a good addition to, if you don't hold them, they're a good addition to investors' portfolios, with the same tone on equities, which is at least selection and cautiousness is warranted, but not a zero investment level.
Yeah, I think what's really surprised investors this year is the high correlation between equities and fixed income. It is such an unusual period, and to see the just how big of a sell-off you've had in investment grade bonds. I think that has been surprising. I think there's a couple things, action items for our investors is one, if you are looking, if you've got cash that you want to hold for the next few years, it's a great chance to kind of lock in with short-term rates, and you can get pretty good rates on T-bills and on in particular on treasuries. Treasuries actually are yielding more than munis on the short end, so they're quite attractive. And then, another area, I think anytime you see something unusual going in an asset class, and we'd ask Adrian this question, but, distressed debt seems to be really interesting, both from the private side and on the public side. And I'm kind of curious what you think about what's going on in that asset class, and would love to hear your observations.
Sure, I'll say quickly, that's a good question. We've seen distressed debt levels compress significantly. So the compensation you receive on a corporate bond is compensation for the potential of default. If you lend to your friend that doesn't have a job, you're going to probably request a higher interest rate because they may or may not be able to pay it back. Distressed reflects more of that compensation for the potential of not getting paid back. That compensation has decreased significantly, but we've seen many more opportunities, in part, I think, because of the lower liquidity of the environment. Investors have been scarce and more nervous on this environment. That has created significant opportunities that we take advantage of in our investment as well. Of those that are effectively biased or that have significant bias against them, which means you receive an elevated compensation. We're seeing more of that elevated compensation in certain areas where there's bias against. Think the energy market is one of those where we still see opportunities in the energy market. Think certain areas of the retail market where there's been a concern on some of the motivations of the consumer on the stay-at-home versus the work at the office consumer or the more mobile consumer. Those have created some opportunities for us that we have found and been able to benefit from. And not just benefit from because prices go up, but benefit because elevated yields will mean multiple years of heightened earnings relative to an elongated economic cycle.
Thank you. Super interesting. And now let's focus on the overall economy. So the yield curve remains inverted. We have seen two back-to-back GDP decline, quarterly declines in GDP. So do you think we are heading towards recession?
So if you look at the yield curve, it is the yield curve tells us that we should expect a recession in the next year or so. It kind of remains to be seen. We don't have as much leverage in the financial system as we have in the past, which is great. And I should back up and say, I think a lot of times when people hear the word recession, they immediately think of 2008, and which was a recession, but that was really a financial crisis. And it's just a normal part of an economic cycle that you're going to go through periods where you have some contraction, and usually it's led by the consumer. Often it's led by credit, which is one of the reasons we watch credit so closely. So again, if you're looking at the yield curve, it does indicate that the Fed is going to have to cut next year, which leads you to believe that we could possibly have maybe a shallow recession. So far, the consumer's been pretty strong, and despite higher energy prices and higher prices and food prices across the board. What's interesting in August is for the first time, real wages were higher than some of the inflationary pressures that we've seen, which was a positive. Kind of going back to if we were to have a shallow recession, that might give us enough time for the supply chain to kind of catch up with us, allow demand basically to come down a little bit, the supply chain maybe to heal itself, which would not necessarily be a big would not necessarily be a negative. I'm not overly concerned about a really deep recession, but a shallow recession I think is certainly a risk, and would love to hear Adrian's thoughts as well.
Yeah, good points. And we agree that one thing maybe that even gives the Fed the ability to right-size interest rate and combat inflation is the global financial crisis, because we saw a considerable drop in consumer leverage, in housing leverage, and other areas that often lead to that leveraged unwind effect that leads to a sharp contraction in economic activity. Whereas this time we have less of that. Less people have taken out mortgage equity withdrawals to go buy the fancy red car this time, and so there's less of a concern of a sharp contraction. That said, the Fed and the cycle point that we're in is one of likely lower economic activity for the next 18 to 24 months. There's a higher potential for a 2 quarters of negative economic growth because of that. Within that, that means what the Fed told us. We're going to see layoffs. We're going to see a higher unemployment rate. We actually need to see a higher unemployment rate because it's hard for the Fed to bring down inflation when they see unemployment. So when they see employment inflation at around 5+% wage inflation, those things are negative, but at the same time, savings buffers have been built up significantly. We have lower consumer and corporate leverage than we have had in the past. So we have less concern around a full unwind and a sharp drawdown in risk. And so elevated risk premium in the environment for that might be opportunities for us as opposed to points to exit.
Yeah, and back to some of your points. It's interesting. It was quite fortuitous. In 2019, the yield curve kind of inverted well before COVID, and that I think was an opportunity for a lot of banks started kind of pulling in their lines of credit and started kind of preparing for a different environment. And of course, they didn't know COVID was going to happen later on in 2020. But I think that kind of worked out well, allowing banks to get more conservative. And then obviously when we went through the 2020, when we went through the pandemic, with interest rates going close to zero, so many corporations refinanced their debt and borrowed money for basically zero. So their balance sheets are in much better shape. And then the consumer was allowed to save a fair amount of money as well by not traveling, not spending any money. And then obviously we had a lot of stimulus as well. So I just think there's so much less leverage in the system, which is a good sign for not having that deeper recession.
Super helpful. And so, Adrian, just to follow up on recession, let's also talk about oil prices. So, oil prices tend to have a positive correlation with the economy. We have seen oil prices on average fall about more than more than 25% since reaching $120 per barrel earlier this summer. A lot of it has to do, with the slowdown in China. But what is your outlook for oil prices, and where do you see it going?
Sure. Well, we are still at an elevated price range compared to where we were pre-Ukraine, pre-geopolitical risk. And I think it's somewhat surprising that we haven't seen more of the impact from a potential demand slowdown from all the things that we're talking about today on oil prices. But there's a good reason for that. And there's a good reason for that in that the space has been one of underinvestment for the last several years, which means more constrained supply lines. We've also seen the Middle Easterners and others that are suggesting that there's limited supply available. Effectively, they are benefiting from OPEC and OPEC Plus keeping prices elevated or supply more constrained. And so we're seeing that, and we're seeing just a longer term geopolitical risk premium. We look at this as not something that is a very near term. This is a multi-year event that's happening. And so we are likely to see elevated oil prices. And when I say elevated, I mean above where we saw in 2011 up till around 2018. We see elevated oil prices providing companies in the energy sector to be constructively cash flow producing. And because of some of the change in how they deal with their capital, as opposed to always drilling, it's going to be a return to shareholders. That dynamic is helpful. That is, you're going to see higher prices for the oil companies, it is, and they're going to be returning more to the shareholders. So we actually see elevated oil prices for some time. Yet when you can look forward in the derivative space at what the oil price forward curve tells you, and it's telling you oil prices are going to drop. So in a year's time, we don't expect to see West Texas Intermediate trading at $95 a barrel. We expect it to see, and the market is expecting to see, $80 a barrel or $85 a barrel. It's lower. That is still an elevated price, which allows these companies to be cash flow productive and return money to shareholders. So we would consider that an elevated environment.
Thank you. Very interesting. And I think the last question, so we talked a lot about inflation, interest rate hikes, global economy, but what other risks, what do you think are the largest risks going forward, and what keeps you up at night?
Yeah, there's so many. So I'll start with a couple that I think about. One, which Adrian already mentioned, is China. So you've got now 34 cities that are in complete or partial lockdowns. So that's significant, and some of the cities are large cities. That continues to impact our supply chain, but also China is the second largest consumer globally. So it does have a big impact on the global economy, and that's something I certainly think about. I think we've talked about in previous calls too that China has, since the 2008 financial crisis, China has also incurred 2/3 of the global debt that was created, and so it's a much more levered economy. And these shutdowns are difficult, not only for the globe but also for China itself. So that's something I think about. And then the energy crisis in Europe is very real and could be a lot deeper than what I think the market expects. So if you look even at some industries that are big consumers of energy. So I was reading an article talking about bakeries, for example. Bakeries are huge consumers of natural gas and energy. A lot of them have contracts. They have hedges in place, and so right now their energy costs might be 3,000 euro a month, and as these contracts are coming off, their costs are estimated to go up as much as 30,000 euro a month, and that's huge, especially for a smaller business. Same, you have a lot of grocery companies that are no longer able to deliver groceries with anything used with dry ice, so nothing that's frozen, because their suppliers are having are being majorly impacted. And I think we normally think about the consumer, but I think there's just much larger and deeper ramifications. Utilities also have regulatory requirements, and a lot of them are getting essentially like margin calls, is the equivalent of margin calls, and having to go out and buy more energy at these higher prices. And that could certainly cause an issue, and could cause a collapse, certainly of a utility company as well. So I think there's multiple things going on there, and we're not exactly sure how it's going to play out, but those are two things that come to mind when I'm thinking about risk.
Yeah, and I'll just add to that, especially on China, where geopolitical risk begets geopolitical risk. There is a concern in Taiwan. If you'd asked me at the beginning of the year, I would have said, not so big. Things have changed enough that as investors, the supply chain has changed. The situation on the ground with Ukraine and Russia and relationships abroad have changed enough that it's something that we need to monitor. We've got in November the potential third term for President Xi of China, and that's one of his key mandates, is reuniting Taiwan and China. So we'll be mindful of that. That doesn't mean it's a likelihood, but it means as investors, it's a downside risk that we would monitor, because look on your clothing, on your desk, wherever, and the number of things that are listed as made in China. Imagine if that were to become a supply chain issue, it would have a considerable impact on the markets. Europe is a big concern. I won't rehash that up because I think Leah made a good case there as well. One other piece of this is we'll continue to monitor short-term financing conditions for companies and markets being facilitated for companies to roll their debt that they have come available. Now, what we've talked about an environment where there's potential lower growth, but maybe less of a sharp contraction in economic growth. If we see that sharp economic contraction, we'll see an environment that we potentially have short-term financing conditions draw down. That was the GFC, the global financial crisis, that led to banks that have overnight facilities to be able to fund their debt positions that no longer were available. Thus, we had Lehman fail. We are highly unlikely to have something like that again, but of course, having lived through that, it means that I'm monitoring those conditions now as an investor to ensure that if we see short-term financing conditions spike, then we observe that as a downside risk. Now, granted, because we all sat through the GFC that are old enough to do so, especially those at the Fed, they're monitoring the same thing, and they would be, you can bet your boots on the fact that they would be certainly facilitative if we saw that, and they would provide supply lines as far as money or swap lines to banks that needed it in that condition.
Thank you. I think this is super helpful, and it makes me feel comfortable knowing that you are all monitoring not just, the obvious risks, but what else can go wrong. These are all the questions I had today. Thank you so much, Leah and Adrian, for your thoughts. And thank you so much, everyone, for joining us today. We appreciate your business, and please feel free to reach out to your advisor if you have any questions. We hope you have a wonderful rest of the day. Bye-bye.
Thank you.